All right. Well, let's start. So welcome to Math 622. Okay. I think most of you have known me already, so I don't have to introduce myself. Okay. So maybe first let us start to talk about what this class is about, right? What I expect you to know, things like that. So if you have any questions at any point, right, feel free to type into the chat or speak on the into the webcam. So Math 622. Right. So what you will learn, okay, are the following topics. So first, Black-Scholes model. So write Black-Scholes only one time in this course, and we'll always write abbreviate SBS model. Okay, formula and PDE. Two, right? You will learn together with this kind of topic. Actually, you will talk about stochastic calculus. And there are kind of like two flavors for stochastic calculus. The first one is for Brownian motion. Again, I'll write it once and then we'll abbreviate as BM. And also another one is for Poisson process. Okay. So in fact, well, the Poisson process will kind of change the Black-Scholes model into a jump model as well. So it will allow us to model stock price with jump. C, right? You will learn, well, option pricing, and option pricing will incorporate, right, European option, exotic option, and American option. Okay. We'll talk about various aspects of option pricing. So I mean, option pricing means the formula itself, but so all the aspects, right, of option pricing, which include the Greeks, right? Implied volatility, I guess I can say something like pricing, different pricing via, right, analytical formula, or using numerical approach, or use Monte Carlo again. All right, once previous MC simulation. Okay, and then so believe it or not, these topics will take kind of the bulk of our time and focus. So we do have, right, the focus of interest rate models, but we'll see how far we can get in this class to to get there, right? Because usually when we get to interest rate models, that's kind of at the end of the class, and we don't know how much time we have. Now, one more thing that so these are the kind of the theoretical topics, right? For the class. So these are kind of the theory in some way. But so if you if you know me, right, I am more I'm kind of I want to advocate, right, for the students, not just to learn the theory, okay, but know how to apply them. So together, right, with this with these things, right, so the followings, right, will also be kind of taught along the way, not in particular in terms of topics, but so emphasis, right, on so several things, right? So first of all, we can do F here if you want, but the one thing I want to kind of use so Monte Carlo simulation, okay? And what I mean by this, right, is just basically use computer program, right, to simulate the model. Okay, so to use computer program, right, use code to simulate the model. And so there are a lot of aspects of Monte Carlo simulation, okay, including the computational aspect, like how to do Monte Carlo simulation correctly, etc. We won't be dealing with that because that's more of a computational finance topic. So you will learn that with Professor Larson. What I want to focus on here is use a very, very basic approach, right, to Monte Carlo simulation. But I want you, right, to so first of all, right, by use code here, definitely that's going to be Python, right, and my preferred format is going to be Jupyter Notebook. What we'll do, right, is just basically use the simplest kind of type of simulation approach, but we want to see, right, not just the model in theory, but when you simulate the model, right, you see how the model behaves numerically. You see all the stochastic aspects of the model in certain ways, and to some extent, right, that's what people do in practice too, right? Use simulation to understand more complicated models that they cannot understand analytically, for example. So encapsulate in this term, right, is a lot of concepts, a lot of techniques, including, for example, right, how do you adapt your code, right, to understand a model, right? There's no fixed formulation to do that, and the more you see, the more experience you pick up, right? So well, I guess it's better, right? I'll demonstrate that rather than say in words, but that's you see that, okay? So again, right, this is I would really like you guys to pick this up, for example, because it's practical and it has a lot of implications in both academic and in practice. Another one is use access, right? I guess we'll call it real data is real data, right? And compare, right? Observe how the models work against, right, the data. So one thing, right, is that you learn a bunch of theory from class, and then you kind of apply it, and you don't have any idea of what that means in real life, right? And so this is going to be, I mean, people or students really don't like to look at real data for several reasons, right? Well, I guess one of the reasons can be that real life data is messy, right? It doesn't conform to model. It just doesn't, right, seem to tell us any much. So in other words, like, in fact, when you look at real life data, then you learn how much our models kind of fail. Or in other words, trying to reconcile, right, what you learn from the model to the data, right, is exactly the challenge that you will have to deal with in your workplace, okay? And so by real in quote here, right, the one that I just want to kind of make everything uniform in this class, we'll use the Yahoo Finance okay, API via Python, okay? So you will need to pick this up, and along the way, right, the one technique that you need to have to manipulate, right, this data is pandas data frame, okay? So if you don't know any of this, or if you're not familiar with this, right, pick up, these things either from online Google, take a course in Coursera, whatever, right? So, yep, so you will be exposed to this theory, okay? But like I said, without the items F and G, right, all theory you learned will be kind of one-sided and not to me, not complete, especially for a program like this. Okay, so that's what you will learn in this class. And you will be actively tested, right, in these things from homework, right, to review session, okay, and to exam in some suitable way. Any questions so far? All right. So okay, so that's what the course is about. So well, if, like I said, right, during the lecture, at any point, if you have any question, feel free to type in the chat or speak into the webcam. So now, I guess without further ado, oh, sorry, right, let's talk about, kind of like resources or, course materials, or where would you, right, learn about these things, right, or course materials, I guess, maybe more like it, right? So first of all, right, in terms of textbook, Shreve is supposed to be, right, our go-to textbook for technical details, but Shreve is rather dense, okay? And I think you probably have some time to play with Shreve, right, at least volume 1 in your Math Finance 1. So I won't be emphasizing so much, right, in terms of that technical details. Like I don't think you should look at Shreve too, if you, at least once, right, to have an idea of how sophisticated the math can be, right? But it's really dense. So if you find it hard to read, you don't have to be discouraged. The one that I really want you to at least spend some time with is Hall, okay? Options, derivatives, and whatever, that textbook. The reason, and I won't say, right, which chapter, etc., right? Basically, Hall is a pretty balanced exposure on, financial products, financial details, stories, the real world story, that kind of thing. And so if you read Hall, it's not time wasted, okay? So if you pick up a topic or you hear something from your, interview, whatever, right? John Hall, maybe your first, could be a good place for first place reference, okay, to a lot of these details. And we'll quote a few things here and there from Hall, as you will see. So this is for financial details, okay? Like financial implications, context, financial context. You can look at Hall. It's an excellent book for that. For technical details, okay, well, I guess the best place for you is to come to class. That's lecture note, okay? So now, I will be explaining explaining, right, technical details as we go along, right, the math. Now, and I also posted, right, the lecture notes, class notes I wrote, well, I know 6-7 years ago, right, when I used to teach this course. That lecture notes is also fine, but it's written with Shift 2 in mind. So in other words, if you read that note, that's meant to kind of, elaborate Shift 2 for you. And so actually that class notes probably is the in-between where, the lecture notes, if you read the lecture notes and you find some details, you want to read more about the math, you can look at my class notes, right, posted on Canvas. And Shift 2 is where, you just kind of want to kind of be aware that there's such a text and, and look at the math at least once, okay? So these are for the theoretical stuff, right? In terms of, right, the code, of course, I'll provide sample codes here and there, but, it won't be enough, right? And these days, if you know me, I always tell you, you have to go learn things for yourself. So, right, enroll in an online course, look up things online, whatever, right? Coding and then Python, that kind of skills is just available, is taught everywhere. You just have to kind of, look at it for yourself. But, Cesar, right, your TA would be a good source to discuss with him about, things along this line, like items E, F, and G. He's quite experienced and he's quite enthusiastic about these things, right? And you will have to attend review session with him anyway. So, utilize your TA as a source of help for these kind of things. But of course, right, do your homework, okay? Know what you want to ask before you approach him. So that's a resource. Of course, ask me any question if you want at any point, okay? Send me an email, ask questions in class, etc. All right. So I think that's all I want to say about the course. Okay, again, any questions? Okay, so let's start our first lecture. And for the first lecture, I'm not gonna do something super crazy, but I just want to kind of revisit the following concept. Pricing, okay, financial products or financial derivatives, right? And then, stock price model, asset model. Okay, so you have learned, these concepts in Math Finance 1, I hope, but I want to kind of, review them and kind of highlight, right, what I think of, right, as an important concepts from these ideas. So let us, right, of course, so start out with, right, I think the first thing you would learn is the idea of the derivative, right? So what is a derivative? And you learn, right, that there are financial assets, right, in the world, and there are financial assets in the world, right, and there are basically, for example, stocks, right, bonds, commodity, right, etc. And so these more or less can be thought of, right, as kind of the primary assets, meaning that these guys, right, derive values intrinsically, right? A stock price, right, move up and down according to how the company is valued, right, intrinsically, at least, hopefully that's the case. The bonds move up and down, right, intrinsically based on, how the interest rate moves. Commodities, right, again, oil price moves on how, the demand for oil behaves. So, so again, right, so it's not a technical term, but we can think of them as a primary asset. Then there's the one that we kind of are trained on, or that's the point of the class like this, is derivatives, right? So derivatives are the ones whose values, right, assets, derive, right? So that's where the term derivative comes from. Derive comes from right, some primary assets, right? So basically, you know, this is the English way, right? It's a wording way to explain what the derivative means. But so mathematically, right? So mathematically, right? And you should be probably used to this, right? So let's take the easy example of stock, right? Bonds or commodities. We can look at later. So for example, you look at ST, right, as a stream of stock price, right? Okay, as a stock price. Okay, so then the next one you have, right, is your derivative price, right? And you want to express the idea that, right, the value is the value of the derivative, right, derived from S, right? So you want to express the idea that the value of V derives from S. So how do you say that, right? Well, so value, right, of V, right, derives from S. So again, right, this statement actually is vague. Well, it does capture a lot of things, but so what people mean, right, obviously is there is a time, right? There is a magical time called expiration time, right? So at expiration, right, that's expiration time T, right? The value is a function, right? And here, right, is where things get tricky. This function can be very rich, right? But let us just do this first, right? And this doesn't even capture it all. So what do I mean, right? So here, so S0T, right, denotes the whole path of S, right, from 0 to T. Phi, right, is specified by the contract, right? So in other words, one feature of this is that if you look at this the derivative, right, and you read the contract, then you would know what phi is. In fact, you also know, right, how the path, right, enters into this phi. So for example, right, you should know all this already. The European call, then this will be ST minus K plus, right? So the function, right, phi of X would be X minus K plus, right? Is specified by the contract because the contract reads, right, that if the stock price is higher than the strike, then you get paid, right? Well, then you can, buy the stock at the strike K, meaning you get paid ST minus K. And if it's below K, then of course you don't exercise the options, so you get paid 0, meaning the function, right, implied by such a language is this, positive part function, right? And the dependence, right, on the whole path actually is only on the last point of the stock, right? That the same as the stock price at the expiration time. So actually, this is not path dependent at all. That's why the word euro applies to it. The word euro, right, means not path dependent, right? Or non-exotic, right? So that's what, so the whole euro call, right, completely specifies this structure and this term, right? Well, if you want to go to an exotic site, right, you can have let's say, an agent call if you want, right? What's an agent call? Well, an agent call could be something like this. Right. So an agent call, right, at time big T at the expiration, right, pays the holder this much. Well, what is it, right? So first of all, right, so what is this? This is like the average price of the stock, right, over the interval from 0 to big T. And so it can read something like, right, well, the holder, if the average price calculated in this way is above the strike, right, will get paid this much. If it's below the strike, he gets paid nothing, right? So the word call, right, also enters into the structure in this way. So that's the function phi. And then, right, the Asian or, the non-Euro stuff, right, besides the American, right? So this is Asian kind of refers to the exotic structure of the derivative, right? Meaning that the payout, right, depends on the whole path, right? As 0t, right, enters into the formulation or the payout of the option. Okay. Any questions so far? So, well, so these, right, capture two important, types of options out there in the world. There's a third one, right, which doesn't quite get captured by this formulation, which is the American type, right? Because the American type is, is highlighted or is specified, right, by the option, by the stopping time. So maybe let's write one more, right? So if the American type is kind of, basically allow the option holder to choose, right? Choose a stopping time, tau, right, or to exercise. So the American option is like, right? So again, the idea that the derivatives derive its value from the asset still holds, right, with the American option. It's just that its structure, right, is even more complex in the sense that, right, there's a fee that gets to that is specified by the option, usually call or put, but also, right, the structure of the stopping time, meaning the holder can get to choose, right, some time where this happens, right, the value of the option, right, also has this stopping time, the random time, kind of exercise time, right? The other options, the exercise time is fixed, right? And we just have to write down the function like this here, right? The function itself is so tau, right? Is a stopping time between 0 and t. Okay. So anyway, right? The business for us in this class is to study these types of options under the Black-Scholes model. So for now, right, I just want to highlight the fact that, right, you see derivatives, right? This mathematical formulation is just different ways, right, to express the idea that the value of the option derives from the stock price. Okay, so that's just derivatives, right? We'll go back to this later, but now let's look at pricing, right? So, so here let me pause, right, and ask you guys, what is pricing? Or, right, when you, I don't know, you go to an interview or you go to, if you talk to people, you say, oh, I'm taking math finance, right? And they're like, okay, what are you learning? You say, I learned option pricing. And they're like, okay, what do you mean? What is option pricing, right? What does it mean? Okay, you better learn to, what does it mean, right? Learn to explain, right, what you learned in a way that people can understand and make sense of, right? That's part and parcel of getting a job or, selling yourself. If you cannot explain what you do and you just say that I do some abstract stuff, okay? It doesn't matter how smart you are, no one will really want you on the team in some way. So starting, right, with any concept, try to explain it in the way that makes most sense, right, to most people you talk to, okay? So yeah, you learn pricing, I hope, from Math Finance 1, etc. Can anyone tell me, right? What does pricing mean, in your opinion? Anyone? You did learn pricing, right? Or should I talk to Professor Larson and ask if he teach you pricing? He taught you pricing. No. Intrinsic value, right? I would say that belongs to the stock itself, right? Or belongs to primary asset itself, right? When we do pricing, do we price a stock? First of all, let me ask that simple question. Do we price a stock? Yeah, so yes and no. You see, right? There's some way you can say, yeah, a little bit, right? But so, right, I would say because intrinsic value applies to a stock, we don't, right? We don't price primary asset in some way. So no, right? In fact, right, the whole pricing term, right? So not really, right? We'll go back to this. But so we price, right, derivatives, right? I mean, that's the whole idea. So in other words, right, the idea of derivation, right, from the primary asset, right? So intrinsic value, I would say, is not quite right the concept here. So what does pricing then mean? Okay, not bad. That's a better right answer. But and that, you know, here's what I want to say. That's not a bad answer, but that would be some sort of routine answer you can get from someone. But not bad, right? I'm not saying that routine is bad, but let me ask, right? When in the word you go there, right? You use the word willing. So are you trying to tell me that pricing is subjective? Meaning I come to you, you're willing to pay this much. I come to another person, they're willing to pay that much. Then we don't have any right universal stable concept of pricing then, right? Because you use the word willing. Who are you, right? And how much willing? Does that make sense? So that sounds okay on the surface, but that actually, right, is problematic. For example, a bank wants to price, right, a derivative. Yes. Do they go to a customer and say, oh, how much are you willing to pay for my product? Of course not, right? If it, okay, fair value, not bad. That's actually another technical term that's good. Let me ask you, what is fair? What does fair mean? Who decides fair? What does fair mean? Ah, okay. We are touching some very good terms. Yep, replication. Yep. So okay, so we can start working with that, right? Now let me say this, right? In fact, first of all, pricing, right? At least, so I don't claim that I hold the truth to what pricing means, but pricing, first of all, you should realize is an activity, okay? It's what we do to the derivatives, okay? And so, in fact, right, what do we do in pricing? So remember, right, in all of these, right, again, strike the American option if you find it's a little bit strange, but it can still apply. In all of these, right, notice that we say that the value of the derivative derives from the stock, right? And it's kind of clear from these formulations. But notice that all of these, right, are at time big T. So like, right, for Tima, talk about time zero, which is exactly one aspect. Meaning, first of all, right? So pricing is to figure out, okay, the relationship v little t to be some function t as t like this, and maybe like this, right? Depends on the path, maybe. And this phi, right? I just use the same. I use the same letter, but maybe I should change it, right? So for any t, okay. So this might sound a little bit, I don't know, not exciting, but that's actually the number one thing, right? We simply do that. In other words, right, what are we trying to do? We're trying to, right, point out the explicit relationship between the stock price and the option price at any time before big T, including time zero, right? So your task and your job, right, from the bank, whatever, is to figure out what this psi looks like. And right, by putting this little t here, I mean that this function will change with time, right? So it's not a fixed function, like say x minus k plus, etc., right? It will change with time, right? So your task is to figure out little t. Sorry, figure out little psi. Does this make sense so far? For example, right? Again, we haven't talked about this yet, but for example, right? Under the Black-Scholes, right, model, right? If the big T is ST minus K plus, right? Anyone who wants to get a job in investment, you know, in as a quant, whatever, better know this formula, right? What's VLT? VLT is ST and D plus, right? At T. So pardon me if, so let me just know, my plus and my T are very similar. Minus K e to minus R T minus T and D minus, where and right where D plus and minus is equal to R plus minus 1/2 sigma square T minus T minus natural log of S little t over K divided by sigma square root T minus T. Hold on, it's been a while. I'm not sure. This is K over ST, ST over K minus log of. Give me one moment. I forgot if this is K over ST, ST over K. It's been a while. It should be, I think it's K over ST. Let me check real quick. ST, yeah, minus K over ST, yeah, or plus. It doesn't matter. You can do plus here. I like to do minus for whatever reason, so K over ST. You can do the other formula with plus. Okay, doesn't matter. So right, so this is the formula. So in other words, right, notice this is the psi function I talked about, right? This is a psi function I talked about, right? So the psi function is this whole complex caboodle, right? Where you see that S little t, right, enters at various places. But right, the structure of the function is this whole thing, okay? And so, of course, right, you want to figure out this relationship. So so first of all, right, this is the activity of pricing. This is the mathematical or the quantitative activity of pricing, meaning pointing out explicitly, or at least write a code or whatever, right? Give people a way such that if they input, right, these parameters, this information, then you output a price. Okay, so that's pricing. So pricing, in a way, is like, if you want simply, right, pricing is a map, right, from future value to present value. Okay. Now, then the next question we want to ask is, what properties, okay, does pricing have to satisfy? Okay. And now we get to one of those things that you guys are discussing, right? So in other words, right, abstractly speaking, any function like this can be called, a pricing activity, right? You have a way to say, okay, I think, right, and in fact, some people do that, right? To value an option, they say, okay, let me guess a number, right? So that's a pricing activity. But then, right, when we lay out, right, a systematic way to do pricing, right, we have desired properties that the price has to satisfy. Okay. So what price has to satisfy, and I think, right, someone mentioned the word fair value. So let's do that, but I would put a question mark, because what does that mean? And then the second one, right, that goes kind of hand in hand with it is replication. Okay, now again, let us question mark that. So in other words, right, whatever, so of course, right, we understand that this function, right, output a number, which now will be understood, right, as the price that we will charge, right, people to hold an option, right, to buy an option from us, like this. Okay. So now, right, what does fair pricing mean? Or what do you mean by fair? And what do we mean by replication? Okay, so no arbitrage. That's another technical term. What does that mean? I'm afraid that's not the explanation for that, right? Because again, right, I guess there's, you guys are throwing technical terms around, but you're not explaining it, right? Okay, so what does risk neutral mean? What does risk neutral mean? Okay, so first of all, right, that's the whole point, right? This is the, I know that you guys are aware of the keywords, but right, this is the bread and butter of what you do. In other words, right, you use this framework, right? We will use a risk neutral pricing framework to do it. I don't deny it. But saying the word doesn't mean, right, you understand what the whole idea is about. So you should at least be aware, right, of some ideas behind these things in case people question, right? And people do question you about these things. For example, I have got questions on interview on whether arbitrage exists in real life, or is there arbitrage? And you talk to anyone out there as a practitioner, they will tell you there is arbitrage. Okay, so when you say no arbitrage, they might frown. Trust me. Okay, so in case you get a shock when you go out there, risk neutral. Yeah. So again, right, that's the mathematical. Yes, that's good. That's one way to put it. Correct. Right. Risk neutral is another, right, where people will tell you that you won't get risk neutral, okay, in real life, because right, the whole point of people investing in the market, right, is to buy risk, right, or to play with risk. Agree? I mean, people entering, if you are risk neutral, actually you will be like me, sitting at home, not being involved in the stock market. Okay, being involved in the stock market means that you are playing with risk. All right, so you better again explain all these things. So yes, Fatime does explain that term very well in terms of the mathematics. I completely agree. It just I would want to dial it down a little bit and make it a little bit more, easier in terms of the English. So right, fair pricing. So there are two aspects, okay, to pricing. Meaning when you name, right, this function, it must satisfy to at least some desirable properties. The first one, right, along the idea of fair pricing, whatever, right, and actually is probably along the line of replication is this, right? So, and this is a more natural one to explain. The idea is this, right? The price, right, the value or the price, right, of the derivative should, right, be just enough for, right, the seller, or for that matter, the buyer. The reason is, the seller and the buyer just takes opposite positions, right, in this transaction. One takes a positive sign, one takes a negative sign, right? One long and one short. To invest, right, in the market, and completely hedge their risk, right, or their exposure to the option. Okay. And in fact, right, trader does this a lot, right? Of course, completely hedge is only a theoretical thing. They might hedge it, but they won't completely hedge it. But hedging, right, is a very important thing that people do. So let's take an example, right? Let's take a very easy example. The forward contract, or futures. We usually try to forward because futures is slightly more complex. So let's just look at forward contract. So a forward contract, right, means you get paid this much, right, at time big T. So in other words, right, this reads that at time big T, right, at the expiration time, you have to pay, right, K for a value of the stock, right? So you get a fixed price for a stock. That's why it's called futures, right? You get a future value for a stock, today, fixed, right? So, okay. So anyone can tell me what's the price of this forward contract, or let's just make it easy, right? What is V0? What does the standard theory, whatever, what have you? What is V0? What's the price of forward contract? What's the price of futures? Do you know this? It should be this. Okay. Now, anything, right? Actually, this should be the easiest one you can price. In other words, I would claim that you don't need any sophisticated theory of math. You only need simple understanding of finance to price this, okay? And that's the point. I want you to understand pricing at that level. So this is the price of a forward contract. Let's understand why, okay? And exactly why means, right? By the way, so the function then, right, was Vt then. Vt would be St minus K e to minus Rt minus T, right? Yet again, right, an example of explicitly naming this function psi, okay? So that's pricing, okay? So for this kind of option, we explicitly price. So right, the one I want to explain, right, is the replication idea. In other words, I claim, right, that with this V0, right, so basically, what is the risk of the cell? So what is the exposure of the exposure? Do I want to look at the cellular exposure or bi-exposure? Yes, cellular. Okay. So what is the exposure of the cellular? Exposure means, right, what are they in for? What are they exposed to, right, as a payout, right? And well, what are they exposed to? Well, they're exposed to exactly this one, right? So they will liable, right, to pay St minus K at time t. Is that true? Right? That's what the option means. And what are they collecting, right? They receive initial, right? It receive initial cash of S0 minus K e to minus RT at time 0. Yes. So the whole idea of replication is to use this cash and invest in the market. Okay. By the way, right, what is the market here for us? The market here is actually not, you know, the S&P, whatever, that kind of fancy market. The market here only means the stock and the money market, right? The saving account, if you will, right? These are the only market open to us because, you know, that's the model that we're looking at, right? There's nothing else. Of course, in real life, you know, you could talk about, well, you can, if this stock is not available, you could, you know, I don't know, find another stock that is similar to it, you know, correlated with it, whatever, right? That's practice, that, you know, that's sophisticated stuff, right? For now, the only one you can invest in is this stock, okay? And by the way, right, let me explain, right, the word exposure in case you feel strange. Exposure, right, obviously is linked with the term risk, right? Now, you look at this and you may not think that is risk exactly in the sense that you usually understand risk. Because, right, if this is what the seller, right, will have to pay, yes, to the buyer. So if, you know, if ST is less than K, then the seller actually gets money, right? Because that's going to be a negative amount, meaning he gains money. So that's not quite risk in the way that we understand it, because we usually think of risk as loss, right? Only when this is positive, then that's risk. But risk here, right, in a lot of times in the context that we're looking at right now, risk just means any random exposure in the future, okay? And hedge away the risk means that you just want to make that randomness go away. And that's kind of what Fatima was kind of talking about, what the term zero probability, that kind of thing, right? You want to make that randomness goes away, right? Go away. Okay. So because, right, where does the randomness come from? Again, it's kind of like very simple, but you better pay attention to it, right? This is where the randomness comes from, right? And you're exposed to that fluctuation of the stock price in the future, and you want to hedge away that randomness, okay? By investing, because, right, this is a fixed amount. This is a fixed cash you're receiving right now. You want to use this fixed cash to hedge away that randomness by doing this, by you, right, entering this transaction of selling the forward contract, right, in the future, okay? So basically, right, to make it natural, right? So what you're asking is you want to buy, right, X shares of stock and invest, right, Y dollars in the money market, or, you know, that's a fancy way to say just deposit into the bank, right? So that, right? So here, just enough, right? It's just enough. The price is just enough, meaning that X times S0 plus Y must be, right? So this is just enough. No more, no less. Completely hedge away, right? Means yes, right? And then this is this. Agree? Right. So, by the way, right, what we're doing here is also kind of implicitly we're doing a buy and hold, you know, activity, which again doesn't have to. You can actively buy and sell, that kind of thing, right? You can do a dynamic hedging, but well, that's complicated, right? Let's just, meaning like it's doable here, right? So we have a portfolio, right? You invest, you buy X shares of stock, and then invest Y like this. You buy and hold, meaning you just keep there and, you know, start hoping, right? At time T, right, your stock goes to this price, your investment go in the bank money market goes to this. Can it match this completely? Okay. So in other words, right, mathematically, can we solve for X and Y for in the above equation? Okay. So now let me tell you one more thing in case you think this is just a system of equation of 2 by 2, which, right, I hope you realize, right? So here the X, Y are the unknown, right? But it's not, certainly it's not a system of 2 by 2. Why? The reason is, right, all these are fixed values, so it's one equation. Okay. Here though, this is not one equation. This is a million and one equations, if you will. Why? Because you want this to completely hash away your exposure. And your exposure, right, is exactly because the stock price in the future is random. So what happens here is that this has to be true for any value of ST. Okay? It has to hold true for any value of ST. So that's what it means by complete hedge. Okay? If it only holds true for some value of the stock price, that's not what complete hedge means, because you don't know what the future will bring. You don't know what the stock price in the future will be. So this has to be right. So the value of your portfolio must be enough for your payout, right? For your obligation. Doesn't matter what it comes to. Understand? So this is a little bit subtle in that way, right? In other words, this is not just 2 by 2 equation. It's rather a million equations. Now, if you're familiar with math, right, that might sound scary because it sounds like an overdetermined system. In fact, right, that's the whole point. The activity of replication, right, gives you a overdetermined system because you have to solve it for whatever future, right, scenario will be, and your degree of freedom is only, right, 2 degrees of freedom, right? So much share of stock and cash. So that's why buy and hold activities, right, doesn't work. Usually you have to do dynamic hedging. But here, right, the answer is yes, amazingly enough for this simple option. And basically you can check that X equals to 1 will do the job, right? And let me see what Y will be. Y obviously is, you know, it stares at you in the face, right? So like this, right? If this is true, meaning you buy 1 share in the stock, right? And you borrow cash, right? This minus sign means you borrow cash to price, to finance your position. Okay. All right. Any question on this? Is this clear on what replication means, at least for this simple example? Okay, so that's replication, okay? And there are a lot to talk about replication in the future. Let me mention real quick about no arbitrage rule. Now, no arbitrage, right, exactly is what Fatime was talking about, but I want to make it a little bit simpler to talk about consistency of pricing. So notice, right, what does pricing do? Notice that by pricing, right, we indirectly introduce one more asset into our market. Okay, what do I mean by this? You usually start out, right, the market with a stock and the money market, right? That's standard. You always have a stock and a money market. Then come along, right, you have some sort of derivative, and then you give it a price. So at least for us, right, theoretically, if you give it a price, that means you can start trading it. That means that you can start forming a portfolio with cash, right, stock, and the derivative itself. And now what Fatime say, right, starts to come into play. There may be a question that if you don't phrase this function carefully, this mapping, there may be a way to combine this portfolio such that you are always gaining money in the end, right? There may be a way, or there should not be a way, right, to form a portfolio with no cost. That's what Fatime talks about with zero initial money, but right, always get money at the end. That's, you know, the probability one that she talks about. Okay, that's arbitrage, right? And basically arbitrage here, right? And by the way, that people in the industry thinks of arbitrage in a different way. So if you want to, you can say, right, this is inconsistent pricing, meaning, right, if there's a way for you to form a portfolio such that it costs no cost and expose the holder to no risk in the end, right, just gain, then that's inconsistent. Why? Because, you know, even academic as we are, right, if there's such a portfolio, people will always buy it, right? Everyone will form such a portfolio and will crash the market, period. So, right, there's no such thing. So the pricing that we come up with should be consistent. In other words, it should not be allowed for such a formulation of portfolio. Now, notice that this idea of no arbitrage is slightly different from the idea of replication. In fact, they're different ideas, right? So sometimes we have this, but we may not have that, etc., right? But ideally, we would want both conditions to hold. And in real life, right, people tend to think of one idea rather than the other. So in real life, people tend to think of replication more than no arbitrage. Academically, risk-neutral pricing pays more attention to this guy rather than replication. Okay. So I do know that I'm out of time, so we will pick this up. Wait, am I out of time? Or I still have 20 minutes, sorry. I have 20 minutes, right? It's 11:40, isn't it? Okay, cool, I still have time, sorry. Cool. All right, so yeah, let's continue, good. Any question about this? About pricing? All right, so we'll go back to this, right? These ideas are deep, okay? Keep thinking about it, keep trying to explain it to people, all right? And we'll go back. But for now, let me talk about switch gear, right? Talk about so stock models, right? And different kind of derivatives. So what do I want to say here? So basically, I want to switch gear and talk about a little bit about, right, stochastic simulation or Monte Carlo simulation. Okay, and it's better for me to show you something rather than, you know, talk about it. But first of all, let me talk about our working, right, the working Black-Scholes model in the abstract in this way. That in the Black-Scholes model, we'll talk about that a lot later. But for now, if you want, you can think of the Black-Scholes model as doing this. It starts with initial stock price. It has a rate of return. It has a volatility. And its randomness comes from something we call a Brownian motion. But for now, this is just a white noise. It's just a normal like this. Okay. So this is not the Black-Scholes model you will see that we'll be using. But anyway, right? So simply, you can use this for now if you look at basically European option. So so mu, right, rate of return, sigma volatility, right? You know what S0 is, so I won't bother. So with so Monte Carlo simulation, what it does, right, is Monte Carlo simulation, what it does is you could, at the very basic level, let's say you can generate, right, 100, for example, values of normal 0t. Okay. And then, right, given this model, you can plug in to the model, which allow you to generate, right, 100 values of the future stock price. Now, of course, right, if you believe that the future will work like this, then what you're doing is you have to generate 100 future scenario for the stock. Yes. Now, if you have an option to come along with it, for example, if you have a derivative payoff, right, such as, let's say, a call option, right, like this. Okay, so here is S, here's the payoff. Then, right, this is K. Then you can see, right, in these 100 scenarios, where is it, right? You can look at the scenarios, for example, here, that's one way to visualize it. Where is it that, how likely is it that you will be in the money? And how likely is it that you'll be out of the money? By how likely, maybe a simple way is, how many scenarios among these 100 scenarios that you're in this region versus in this region. Okay. And right, again, this is very academic, right? It's just kind of seeing it with your eyes, but it demonstrates, for example, right, the whole point of like Monte Carlo simulation. And let's take a look at that real quick, okay? Because that's easier seen than, you know, said in math. So let me show you. Okay, so you should have access to this code. So here, this is, right, I simulate 15, right, future stock price at these parameters. And like you see, right, that stock price is 100, strike is 100. Okay, so what do you see, right? You see, maybe it's unclear, right? Is it likely that the stock will end up in the money or out of the money? Right? Well, it's not clear, right? Because the point is kind of jumbled like this. Maybe let us try again with 30 points, right? The point of simulation is exactly that we can play around with these ideas. So let me see. Oops, why does it not run? Okay, there, right? So what do you think, right? Here, is a stock likely to end up in the money or out of the money? Really? Is it more on this side or on this side? Okay, by the way, this is the payout, right? So this is in the money. It seems like it's more likely to be in the money, right? There are more points on this side, no? Yeah, right. Also, you can see, right, how far the payoff will be, right? You could get the payoff like this, but it's rare, right? It's rare. Most of the time, you can have such a payoff around this range, which is a little payoff, right? You can get a lot of payoff, but rare, right? So again, that's simulation for you. What else can you do? You can wonder the effect of volatility on such a payout. For example, right, if I increase the volatility to, let's say, 30%, right? One activity you should do is try to get some sort of intuition of this. If I increase volatility, how would this picture change? Would it spread out more on this side? Would it spread out more on this side, or it's hard to tell? Well, let me make it easier, right? Maybe let me say keep the volatility the same, but if I increase this to, let's say, 1%, sorry, 10%, right? If I increase the return, which side would it end up more on? In the money, right? For sure. Let's confirm that. Clear, right? Okay. So, of course, right, we just don't want to play around with picture, but picture is one thing that is helpful. From here, obviously, the next step is you can calculate, right, the payout and average it out to get some kind of price, right? That's all pricing is about, using simulation. We'll talk about that. Now, you can do the same thing, obviously, with the put option, right, in the opposite side. Now, the next thing, right, is I want you to at least be familiar with the ideas of in the world, it's just not stock and it's just not call and put. Okay, we have other kind of options that, amazingly enough, first of all, can be constructed from call and put, right? So these can be synthesized out of call and put. So this is a payoff shape, right? But you can synthesize it out of call and put. But more importantly, right, you have to realize that why do people enter such a option, right? So it has to do with, let's call something called risk appetite, right? Someone buys a call option, right, clearly in the bet that the stock market will go up. Yes. Someone buys the put option clearly, right, is in the, I guess, the bearish, right, mood, meaning they think that stock market will go down, right? Now, if you look at the strangle option here, right, and conventionally, right, we think of people buying the stock in the right in the middle, okay, of this payoff range. So a strangle has two strikes, one at 100, one at 120, right? We conventionally think of people buying the strangle when the stock is in the middle. And by the way, right, this you can read about this option, okay? These derivatives in John at least my reference has it on chapter 12, okay? It might change the chapter, but it calls financial products or something. So, but anyway, why would someone buy a strangle? What do they have in mind? What kind of risk appetite are they thinking of? Conversely, right? Why would someone buy a butterfly? What do people? And again, right? Thinking of the stock is in the middle. What are people thinking of when they buy these kind of derivatives? What are they hoping for? Can anyone tell me? Right? Again, this is about developing your financial intuition. So a way to think of this, right, is pay attention to the in the money region and out of the money region, right? Absolutely, great. Now, if you say high volatility, you don't have to say either direction, right? Because volatility has no direction, agree? So exactly, that the investor is betting on high stock volatility, right? Because obviously any investor wants to be paid, right? So they want to end up on these regions. And high volatility, high swing will get you there, right? And we can test this by dialing up the volatility. So on the butterfly, what is the investor betting on? Low fall. Okay. Now let us check. So look at this, right? Is this mostly in out of the money or in the money in this current picture? Really? Out, right? There are more points here, I think. Okay, let's run again. Agree? More point here, right? More points here. Right. Okay, so now let us dial up the volatility, right? Let's make it 0.3, 30%. Okay, what do you see? Which one has higher chance now? In the money or out of money? Okay, so that exactly confirms our intuition, right? That an investor buying the strangle, right, is betting on the volatility being high because, right, they will get paid. They're more likely to get paid. And again, the simulation simply demonstrates. Any question? Okay, now a butterfly, right? And let's see if we can make the volatility high, right? So if I change the volatility to 30% here, what will happen to this picture? If I change volatility to 30% here, what will happen to this picture? It'll be more spread out over these regions, right? See? So in a high volatility situation, right, butterfly actually is not, not a good deal. Okay. But now let's try 0.05, right? Very low volatility. See? Now mostly it's in the money and the investor gets paid. Is that okay? So that's what this is what I mean by, right, simulation. Of course, this is very toying around with the idea. We will run more numerical things, but this, right, is also part of the education, right? You use simulation to demonstrate the ideas, help you understand, right, the financial intuition behind things. And most importantly, you see, you can just change the parameters, okay, and confirm or deny your intuition. Okay, very important. That's what simulation does in real life too. Maybe not in pictures, but any questions so far? All right, I have 2 minutes. Let me talk real quick about the other thing that I have on. We will revisit this, okay, next time, but you will see this in your review session, I hope. So do you see what I'm, the new Python notebook, right? This is for playing around with real life data. So you will need to import, you will need to install, right, Yahoo Finance, okay, to use the code below. So you definitely have to install Yahoo Finance once, okay? But after you do that, you can just comment it out. So a bunch of things about importing, right? And here I import the S&P 500 from 2017, right? And this is exactly data frame, right? Setup that shows you all these things. And right, the whole point of playing around with the data, right, is that you can look at it, right? And to confirm, right, that this is real data, you see a dip here, right, in 2020, early 2020. Does that make sense? Does that correspond to something that we know in real life? Exactly, right? This is COVID. Okay, so yeah, this is real data, right? And then, right, here's what I do, right, real quick, is looking at the price versus the returns and the price difference. The point is, eventually, you see next lecture that we want to model the returns. And the point is we want to assert that the return is something like white noise, okay? Which clearly doesn't hold, right, because of COVID. And so the point of real life data, right, so this is checking autocorrelation, is you can play around with different time period, right? Notice if we take away the COVID period, the picture looks much better. So this is lesson, right, 101 about real life data, right? Model and real life data doesn't have to correspond to each other. It's highly sensitive on what kind of data we use and for what purpose, right? And finally, there's the idea of monthly data, which gives you a lower resolution, right, of the picture. But the point with monthly data is that you can shift out the average return, because now you see the S&P has a monthly return of about 1%. But if you look at the return daily of the S&P, you might as well say it's zero, no return, right? In fact, no stock has any return daily, average return, right? So all these things you will not get, right, from theoretical consideration. You have to play with real life data, right? So this is what I expect you to be able to do for your review session, for your homework, right? So play around with it, okay? We'll talk more next time. Any question? Okay, very good. Oh, sorry, one more thing, right? So your review session will be Monday, okay? 2 to 3:20. I'll send out an announcement, but it should be that Cesar will reach out with more details, right? So tomorrow, no review session because you have Professor Larsen's class. Okay. All right. If nothing, then I'll see you on next Tuesday. Okay. Thanks. Thanks.